survey says HECM professionals make their best guess on possible future HECM changes and much more. As the final days of summer pass, the collective tension of reverse mortgage professionals increases, that in anticipation of what possible changes HUD will make to the federally insured reverse mortgage program. As August or September bring us the changes for the following fiscal year, and that begins in October, we asked you for your top 3 guesses of what to expect. 55% say major changes will be made for the next fiscal year. 44% are confident we may be spared another round of HECM reforms. But when it comes to the specifics of possible changes, only 14% expect another principal limit factor reduction. 32% expect that HUD will lower the interest rate floor below 3%, that in anticipation of decreasing rates. Over 50% expect that HUD will reduce the growth of the HECM's line of credit, or at least access to less of the growth of the principal limit as it grows over time. Custom responses include bring back the saver. The collateral risk assessment second appraisal will be made permanent, and someone else said the elimination of the 60% first-year distribution limit. Those were their suggestions. Now, it's my hope that any future reforms do take into account the impact of recent reforms, such as those that we saw in October 2017 and the loss ratio of loans written after that time. The challenge is that very few HECMs originated just 2 short years ago have actually terminated, so it's nearly impossible to see how effective such changes were in reducing insurance claims. While previous cutbacks should be significantly reducing our future losses to the fund, the current onslaught of insurance claims from HECMs that were originated before the housing crash and also before the financial assessment was enacted, those will continue to increase for the next few years. Now, besides guessing what changes may be coming our way, there are more timely and important topics that warrant consideration. While there has been much hand-wringing in the press that a possible recession may be coming, we find ourselves with actually 2 distinct advantages today: stable and moderately increasing home values and falling interest rates. Older homeowners that have a mortgage stand a better chance of qualifying than they did just 6 months ago or even 1 year ago. Now, historically low interest rates will actually improve the actuarial projections of the HECM's future economic value. That's because the loan balances will be growing slower in that rate environment, and that's good news for the next report. The only downside for existing borrowers is that they're going to see their line of credit growth slow or their principal limit factor growth slow in the coming years with low interest rates. Now is the time for you to revisit anybody who may have actually been short to close due to a higher mortgage balance or a lower principal limit, that due to higher interest rates. Another opportunity can be found in HUD's recently relaxed condo guidelines for FHA approval. Many seniors living in condominiums now be able to qualify for a reverse mortgage or FHA loan thanks to spot approvals or single unit approvals. With only 6.5% of all condominium projects actually being approved by FHA and the popularity of condos for seniors that are looking to age in place, this is good news. Now, what are your thoughts on the survey of potential upcoming HECM reforms and also the opportunities that are presented with low interest rates and HUD's new condo rules? You can leave your comments below, and everyone loves somebody who shares, so if you would share this video with other reverse mortgage professionals, we appreciate that as well. Thanks again for watching and have a great week.